Hi, I'm Vicki Marsh with Berkshire Hathaway Home Services, Florida Realty.
And hi, I'm Peter Mendoza with Prosperity Home Mortgage.
Is your mortgage payment more than it should be? Today we're going to talk a little bit about what you might be able to do to reduce that monthly payment.
Okay, Vicki, so today we're going to talk about private mortgage insurance, or PMI. And this is an insurance that's typically required by your lender when you put down less than 20% on a conventional loan. So what we're showing here is some examples of what that PMI payment would be per month. We're assuming here that it's a $450,000 purchase, and we put down either 5, 10, or 15% down. You can see here that the more you put down, the less the PMI payment is per month. So in this example, it can range anywhere from $128 a month to $38 a month, depending on how much you put down.
So what are ways to remove that PMI insurance? Well, the first thing is you make all your monthly payments, don't pay any extra principal, and once your loan balance reaches 78%, then the lenders must remove that PMI insurance, and that's called the Home Protection Act of 1988. Another thing that you could do is pay some extra money towards the loan balance. So you could make an extra payment a year. You could add additional money towards the principal payment each month. If you get a bonus or an income tax refund, you could make a big lump sum and have that applied directly to your principal balance. You can also, if the interest rates go down, possibly refinance your home and get a lower interest rate and remove that private mortgage insurance as well. And lastly is home appreciation, and that's what we're going to talk about a little bit more in this video.
Okay, so what we're showing here is an example of a homeowner who purchased a home for $450,000 2 years ago, and we're assuming that that home is appreciated 20%. So the current value of that home is $540,000. Now in today's market, a 20% appreciation in the last 2 years is not that uncommon, so this is a very real scenario for many folks out there. So what we're showing here is the amount of equity that you would have in that home after 2 years, depending on how much you put down originally. So depending on whether you either put 5, 10, or 15% down, the equity that you would have would range anywhere from 24 to 32%. But the important point is that all of these equity values are above 20%. And so in all of these cases, you would be eligible to apply to have the PMI removed.
Good to know, good to know. So now what? If you've made all your mortgage payments on time, let's talk about what can you do to remove that private mortgage insurance from that monthly payment.
Okay, Vicki, so the first thing you would have to do is to contact your mortgage servicer and actually request that the PMI be removed. Now, what the mortgage servicers are going to do is they're going to determine the value of your home. And that can be done in a variety of ways. It's kind of up to the mortgage servicer, but they could start with something as easily as an online evaluation or appraisal of your home. It could be a drive-by evaluation or appraisal, or they may actually require you to pay for a formal appraiser to determine the value of the house. Now, the good news is that even if you do have to pay for an appraisal, you can easily recover the cost of that appraisal because you're going to be saving quite a bit of money on your PMI every month. So you should be able to recover that money fairly quickly.
So in conclusion, removing private mortgage insurance from your monthly payment could definitely save you money now. And with real estate taxes and homeowners insurance costs going higher and higher, the amount that you save might actually be able to help pay for those rising costs. If you found this video helpful, please hit the like button and subscribe to this channel. I'm Vicki Marsh with Berkshire Hathaway Home Services, Florida Realty.
And I'm Peter Mendoza with Prosperity Home Mortgage. See you next time.
Bye now.